Welcome to the Explainer. Let's just dive right in, shall we? Today, we're stripping away the investing noise, the social media hype, and all those endless forum debates. We're going to show you how to build a robust, incredibly simple portfolio. We're taking the foundational principles of smart asset allocation and distilling them down into an effortless strategy, specifically tailored for Canadian investors.
So, I want to kick things off by asking you a serious question. Are you actually diversifying, or are you just duplicating? Look, it's a trap so many of us fall into when we start our investing journeys. We buy multiple funds under the illusion that we're somehow reducing our risk. But in reality, we're just creating an absolute administrative nightmare that ends up costing us dearly.
I like to call this the Reddit portfolio trap. You know how it goes. You jump online and see people heavily recommending an all-in-one fund like XEQT. Awesome. Then someone else jumps in and insists you absolutely must hold VFE to capture the S&P 500. Then another thread mentions VGRO, or maybe a shiny new dividend ETF. So what do? You buy them all. But here's the glaring problem. Holding an all-in-one global fund alongside a dedicated S&P 500 ETF means you are literally paying twice to own the exact same companies. I'm talking about Apple, Microsoft, Nvidia. Guys, that's not diversification. That is straight-up duplication. You haven't lowered your risk at all. You've really just concentrated it with a bunch of extra paperwork.
And the sheer cost of that duplication, it's staggering. $90,000. That is what this manufactured complexity could cost a standard investor putting away just $500 a month over 30 years. Seriously, when you mix, match, and constantly tinker across multiple overlapping funds, you usually end up pausing your investments, missing out on crucial compounding, or just second-guessing your entire strategy. That behavioral drag, it can easily lead to a 2% underperformance. Over 3 decades, that wipes out $90,000 of your potential wealth. So let's fix that right now.
Okay, moving on to our first big piece of the puzzle, the all-equity core. Specifically, we're looking at VEQT versus XEQT. Now, these two funds act as the ultimate global growth engine of your portfolio. Both are phenomenal tools that basically give you a complete global equity portfolio in a single ticker. And hey, both recently slashed their management fees to an identical 0.17%. So cost? Not really the deciding factor here. But look closely at the total holdings. VEQT casts a much wider net. It holds nearly 13,700 companies across the globe compared to XEQT's roughly 8,500. By tracking broader indices, VEQT captures literally thousands more small and microcap companies. You'll also notice VEQT leans just a bit harder into the Canadian market with a 30% weight versus XEQT's 25%.
But to truly understand these funds, we've got to look deeper into the architecture behind them. The absolutely crucial point here is their structural ownership. Vanguard operates on this really unique investor-owned loop. Its mutual structure means the funds own the company and you own the funds. There are 0 outside shareholders. So, when Vanguard cuts fees, those savings flow directly back to you. Boom! BlackRock, on the other hand, is a publicly traded titan. They answer to external shareholders on the New York Stock Exchange who naturally expect profit margins to grow. Look, both offer incredible products, but Vanguard's structural architecture is uniquely aligned with your long-term interests as an investor.
Now let's look under the hood. Inside, VEQT behaves like a breathing portfolio. It pins your Canadian exposure at around 30%, which, by the way, is a deliberate, research-backed home bias designed to lower volatility for us Canadians. But then, it lets the rest of the world just breathe. It allocates the remaining 70% based on organic global market cap momentum. So, if the U.S. market shrinks relative to the rest of the globe, VEQT's U.S. sleeve naturally shrinks right along with it.
And this brings us to a massive philosophical difference in their allocation styles. VEQT is alive. Because it uses market cap weighting for the rest of the world outside of Canada, it adapts automatically to global economic shifts. XEQT, however, is kind of frozen. It uses fixed targets, pegging the U.S. exactly at 45% regardless of market momentum. If global market dynamics shift dramatically, those targets only change if BlackRock management manually intervenes to adjust them. So you could argue VEQT is the more pure passive approach to indexing here.
All right, on to the second piece, ZAG, the volatility cushion. This is all about how we control your portfolio's risk.
Listen, 100% equity fund is absolutely fantastic for growth, but man, it's going to be a bumpy ride. You need brakes. Enter BMO's Aggregate Bond Index ETF, ticker symbol ZAG. This is your ultimate shock absorber.
For an ultra-low 0.09% MER, it tracks the broad Canadian investment-grade bond market. With a single purchase, you're getting instant diversification across over 1,500 Canadian government, provincial, and corporate bonds. And it currently yields around 3.46%. When the stock market plummets, and it will, high-quality fixed income like this tends to hold steady or even rise, completely smoothing out your overall portfolio returns, so you can actually sleep at night.
The curve you see right here? That's known as the efficient frontier. It's like a giant puzzle. By actively combining a core equity fund like VEQT or XEQT with a bond fund like ZAG, you get to create a custom split. Maybe your age and risk tolerance call for an 80-20 split or maybe a 90-10 split. You aren't just blindly chasing returns anymore. You're intentionally optimizing your portfolio's long-term volatility to perfectly match your personal financial timeline.
Which perfectly tees up our next crucial topic, tax-efficient bond placement, because where you park ZAG really matters.
Deciding what to buy is honestly only half the battle. Deciding where to hold it across your different accounts, just as important. We first need to clearly define interest income. This is the yield generated by bonds. And here is the kicker, folks. The Canada Revenue Agency taxes interest income fully at your highest marginal rate. It does absolutely not qualify for that preferential dividend tax credit the Canadian stocks enjoy. So when it comes to taxation, interest income is pretty much the least tax-friendly type of investment return you can possibly earn. So the absolute linchpin here is your account placement. If you hold ZAG in a regular, unregistered taxable account, that interest income gets totally hammered by taxes. It creates a massive drag on your real yield. And this is exactly why ZAG firmly belongs inside the protective shelter of a TFSA or an RRSP. In those registered accounts, the interest grows completely tax-free or tax-deferred. That means you keep 100% of that yield working directly for you. No brainer, right?
Finally, let's talk about rebalancing and simplicity, and how to maintain this portfolio completely effortlessly.
Maintaining this beautifully simple setup requires practically zero effort. Seriously, here is your rebalancing playbook. Step 1. Check your portfolio just once a year. That's it, once. Step 2, simply direct your new, ongoing contributions to whichever fund, your equity core or your bond cushion, has drifted behind its target weight. If equities had a rough year, your new cash goes there, organically forcing you to buy low. And step 3, completely ignore the market noise. No complex spreadsheets, no massive sell-offs, no stress, just smooth sailing.
And this really brings me to a core philosophy I want you to take away from our explainer today. Please, stop over-optimizing. Simplicity is literally your ultimate investing superpower. The financial industry profits by making things seem super complicated, hoping you're going to trade more, churn your account, and rack up fees. By resisting the urge to tinker, tweak, or add the latest shiny ETF you read about on some forum, you capture the market's long-term compounding entirely uninterrupted.
I want to leave you with this incredibly powerful reminder from the legendary Charlie Munger. The first rule of compounding is never interrupted unnecessarily. You now have the absolute ultimate blueprint. A globally diversified equity engine in VEQT or XEQT, a rock-solid bond cushion in ZAG, and the exact knowledge of which tax accounts to use. So set your targets, automate your contributions, and let your money do the heavy lifting while you go out and actually live your life. So looking at your own brokerage account right now, what is the one unnecessary ETF you're going to cut from your portfolio today?